Up. I think tonight we're going to be talking about traps. So this is going to be pretty interesting. It's going to be pretty fun, hopefully. And we'll see where we're going. Again, I don't have anything prepared, so we'll just go with what we got. But so as far as traps, it's a pretty interesting topic for anybody to actually even wonder about that. A lot of people think that if you just learn something, that you'll do pretty good, and maybe you'll figure out some holy grail type of trading strategy that just works really good in any environment, and that if you can do that, you'll make a lot of money. In which, in many cases, it actually does work, and it works really well until it doesn't work, and then you get clapped and you end up losing everything. And that's how majority of retail traders are. Is they think that if they just learn something and it works really well, then it's going to work for every time in the next 10, 15, 5 months, years, whatever it is. And they feel like they don't have to do anything to it. The problem with that is that the markets are probably the most adaptive instrument in the world. And unlike any other market, like let's say real estate or something else, there's always something dragging the market. And you can call it a glitch, you can call it a fault, you can call it whatever you want. But there's always something in the markets that usually are there on purpose to, basically allow people to rush into them and then trap them in there. It's kind of like a bait, where you just have the bait just sitting there and somebody comes and tries to bite off of it and it works. And then the other guy comes and he bites off of it and then it works. And it keeps working for so long until the herd gets into it, right? Once everybody in retail starts to notice that, then usually everybody goes in there and they get trapped into it. And this happens with a lot of things. And every year, every few months, it's always something new. The most recent thing, we'll say, for example, is something like what Nancy Pelosi has done. Past 5 years that I've been here, nobody's really talked about senators, or even all the way back to 2008. Nobody really cared for what senators are buying or what senators are selling. And only until 2018, I think, when Trump was in office, somebody was starting to bring up Austin and some of these other guys who were in Congress who were trading. And they found out that those guys were doing pretty well off compared to many of the hedge fund managers out there. And then it kind of had its thing back in 2018 and then disappeared until all the way back in 2021 and 2020. People started bringing up Nancy Pelosi when she bought up Roblox and some of the other stocks. And everybody kind of ignored it until Roblox had that massive rally all the way from the $80 to that 140, and then everybody started looking into it. They're like, well, maybe I can just copy some of these senators and everything will be great. And then they realized some of the senators kind of sold too early before the pop. Other ones ended up selling too quickly. And then Nancy Pelosi just recently made a trade in which she bought Roblox, Micron, Disney, and some of these other guys in Google, in which many of them ended up getting clapped. And then people were like, well, why is it that now that I decide to follow her, I get wrecked, when before it was working out pretty well? And that's something the markets do. And like I said, every year some new trap comes to for people to kind of lure them in and then bait them into something thinking that they just found the glitch of the market. But as soon as there's too many people that pile into something, it definitely makes it rewarding for the market makers, the investors, the institutions, whoever it is, to just trap these people, because there's a lot of good goodies in that trap that they just had. Versus if it was just one person, they wouldn't care much because there's not much worth fighting for. And that's how the market functions. And that's how the market has been functioning since day one, that it's all about setting up traps, getting people ready for those and preparing them and making sure that they have armies of complete morons who don't know any better to just go ahead and think that they just discovered something. And a lot of institutions and a lot of professional traders use this stuff and they understand it. But the only difference between the upper class and the top hedge funds and the analysts and all these other guys is, well, they understand one thing the majority of retail refuses to learn. It's not that they don't understand it, but retail refuses to learn this, and that is get in and get out. Stop getting married to investments like majority of retail likes to do. You've seen this with the AMC situation. You've seen this with some of these growth and hyper growth companies. The problem is marriage. Everybody wants to be married to these stocks. Nobody understands that all of these good things that reward more than normal come down in a very aggressive way. And throughout the past years, the same mistake has been repeated. And it's mainly because it's always new people that get baited by this type of stuff. But even some of the people who've been here for a while, they just somehow refuse to learn. So one of those things is the idea of conditioning. So if you don't know what conditioning is, the market makers do this thing where they condition people to do something into baiting them into a bigger outside macro event that retail or even hedge funds even fall into this trap that they're not aware of or that they don't know will happen. One such thing is the conditioning of buying the dip. And markets like to do this to drive up FOMO, to drive up people into a very, stupid phase in which they defy all laws of logic and they think that nothing bad will happen because nothing bad has happened. And they do that a lot. And like I said, the main one tends to be the buy the dip, in which markets just go in a straight arrow and every dip gets bought and every dip gets bought and every dip gets bought. And by the time you catch on to it and you're like, whoa, I just need to buy any 2% pullback. Well, you buy it and it works. And that's technically where you're getting very, very close to the top. And then it happens again and you buy the dip and then you get slaughtered. And then people are like, well, maybe I should have done this early on, not all the way at the top. But conditioning like this becomes very, very common for people. And then they do it again just at bigger scales where they like buy the dip, and then you get slaughtered. And then you buy the dip and it works and it works and it works and you get slaughtered. The difference is that institutions benefit from this stuff while retail tends to be very stupid in the way that they do this. The reason is because retail tends to be more aggressive over time, while institutions and major hedge fund managers and asset managers, well, they become more conservative over time as they win. So retail, what they will do is majority of the time they'll like a stock and they'll buy it, and it'll go really well for them. They'll buy they'll watch the dip and they'll see it rally and they'll buy the dip again, and then they'll see the rally and it works really good. And then on the third time they'll triple down and go all in and be stupid with it, and then that tends to be the final time for the drop. While asset managers and smart individuals, you could say, well, at least people who use their brain in a smart way, right? Retail is no dumber than institutions. We just choose to make bad decisions. They would tend to start very aggressively, and then they get more and more conservative over time. They do not start to add up and load the boat and use leverage like retail does, which is the biggest downfall of retail. Is we like to get more and more aggressive as things prove to be against us, not with us. So that kind of also takes us back to the next topic, which is when do you buy and when do you sell and how do you avoid traps? So people usually what they will do is that they'll buy something that's dipping and then it'll work out and they'll be very happy, and then they buy the dip and they think, well, it's gone lower, it must be at a better price now. How much lower can it go? And then, well, you add and then it goes even lower. Like, well, now it's even a cheaper price. And then you keep averaging down as something goes down. Why? Well, because many of you have been conditioned to the idea that, well, the market goes up long term, bro, right? Everything tends to work out at the end of the day. And while that might be true, you want to ask yourself based off what data, right? Do you not use your brain to really think about the data that you guys hear about the markets being up 10% year over year? Do you guys not look at the data? Do you not look at the charts? Do you not look at the market? That data is only from 2010 moving forward. That's why they give you guys only 10-year data. Nobody gives you the 15-year. Nobody gives you the 20-year. Why? Because we've had two back-to-back recessions in 01 and in 08, which basically said that the past 10 years, if you would have bought stocks and held them, you would have made nothing. But the reality is they'll only mention this stuff to you because, well, it's more comforting to you because, well, 10% year over year sounds great. And as long as you can buy those, good value names, you'll do pretty well. Those are also traps as well that many people do not understand. So what you have to do as a retail investor or trader is you have to know, when do I make moves and when do I go ahead and be more conservative? There's never a time for you to sit out, which is what many people do is I'll just sit and watch this, right? Let's see what happens. Well, if you sit out too far, you end up missing. And what happens is, well, you tend to only get the last parts of everything. You are basically the guy who will buy here and then get this move, but you'll miss this, you'll miss this, and you'll miss this, and you'll miss this. So why? Because while you're sitting there waiting for things to confirm and all that other crazy stuff. Why? Because, well, there's usually a lot of things that interfere with this. in which the biggest one tends to be the fear of the markets. And we've talked about this before, that markets tend to crash off uncertainty, right? Where they go down. The markets tend to always go down off uncertainty where people are very confused. So, whatever it is that people are confused with, that's usually when markets tend to crash. Markets do not crash on anything aside from that. And the markets tend to go up based off fear. And that's something that a lot of people do not understand. Usually, when fear starts to, get really, really toppy and peaks, that's usually when the markets start to reverse because of one thing, and that is liquidity in the markets, right? So if you look at a stock and you want to buy a certain position of it, and some institution is interested, the only guy that's going to be able to reverse a market is a hedge fund, an institution, an asset manager, whoever it is. They're the only guys who can reverse a market to basically ease off the stress from the downside. The problem is these guys cannot buy unless retail sells. So all these retail dummies that are in there, institutions are just watching them. They're like, okay, when are you going to sell so that I can buy? And nobody knows when that's going to happen is the issue. So even hedge funds try to call the bottom and they say, well, I think they're going to sell here. And they even get clobbered into the wave. The move is only perfect when both align. The move is only perfect when both retail and hedge funds and institutions align, meaning that the retail has to sell to a hedge fund or the other way around to crash something. Aside from that, you're always going to have liquidity problems because if a hedge fund tries to buy too early before the bottom, what will happen is it will bounce too much and then the rally will fake out and die. There will not be enough pressure to continue the FOMO pushing. And that's usually what happens in a lot of cases. But if they can perfectly time it in which they understand when does retail finally become fearful, which all of you guys know when you're really scared. How many of you guys recently with the previous crash, when the market was down to 420, many people gave up. They're like, no more. I don't want this anymore. I don't want to trade. Screw everything. My stocks are down 50%. I want to call it a day. Bunch of YouTubers started making videos that they're selling and they're out. That's when you know peak fear has happened. Is there a way to get indicators on that? There is a bit, but not too many. Because at the end of the day, even if fear peaks, we still need the hedge funds to buy. And even if fear peaks, you still need the retail to sell to provide that liquidity for the rebound. So that tends to be one of the biggest traps in markets in which pullbacks tend to be very aggressive and everybody's always confused on where do you buy the dip. And if I buy the dip, well, majority of the time you'll always be wrong because you're the cause the dip stops dipping. You're the reason why the dip stops dipping is when you sell, it initially stops dipping. And many of you have experienced that where how many of you guys have had a stop loss hit and then the stock just completely rebounds? You're like, bruh, only if I would have held a bit longer. No, if you would have held a bit longer, it would have kept dipping. Nothing would have changed. Nothing would have changed about it. But the problem is with us humans is we're so alike. We are so alike that when you sell, I sell, and he sells, we all think the same way. And therefore, we tend to all perfectly nail the bottom when we sell majority of the time. A good chunk of the time. Unless you're special and you're using certain other advantages in which you kind of basically try to tell yourself, I need to get out here or I need to be in the market here, majority of the time, you will be no different than every other retail trader out there. So that trap happens, and a lot of Wall Street guys and hedge fund managers have put billions of dollars into research of human psychology and trying to get the hang of this stuff of trying to understand when do people freak out, when do people panic, and that's usually when too much pain is endured and these guys cannot go ahead and take that pain anymore. And that tends to be the final cycles of the market. So that's mainly one of the traps that you can go ahead and kind of pay attention to. And you have to really ask yourself that if you are trading based off your emotions and what you feel and what you think is a good price, you're literally falling into the trap. Like literally with that mentality and that mindset, you're falling into the trap that these guys are calling you into because of that. Why? Because again, you provide liquidity for those market makers to cause the rebound and the reversal. So hopefully that part is clear. Now, the other part that I wanted to just kind of focus on a bit is the idea that markets crash on uncertainty and markets go back up on fear. A lot of people do not understand what that means. They think that the market crashes because everyone is scared. Markets have never crashed because of people being scared. And by never, I mean never. These crashes are not caused by fear. 99.999% of all market crashes have occurred because of uncertainty. The markets do not like throwing a coin in the top because the issue is the markets will go ahead and be very, we'll say observant of everything, but they're also very scared of things. So therefore, what does the market do? Every time there is uncertainty, the market prices in the worst. Keep that in mind. Anytime there is uncertainty of something, the markets price in the worst scenario. So during the COVID right here crap, when this happened, the markets, before anything even happened, priced in this is where we would be if COVID was as bad as people said. Before COVID did anything to the economy, earnings had nothing. Nobody even got hit by this stuff until literally 2020, like the middle of it, all the way here in July. That's when the stuff started to come back. And then the markets were already back where they started. So the market initially actually went down on the uncertainty here because it has priced in the worst. And that's the thing you guys need to be very cautious of. Do not fall into the trap of fear. As long as there's uncertainty in the markets will go down. Once everything is said, do not be scared. There could be a slight continuation, right? There could be a slight continuation here, but do not be scared of that. You have to go ahead and call it a day. So when you guys saw this crash right here, when it came all the way down to here, there's a reason why we said, okay, maybe we're in a wave 4 correction. This could go back to 450, or it could just completely tank off 430, dependent on whatever happens. Why? Because the majority of the uncertainty is gone. This crash was literally in preparation for Powell because people said 5 rate hikes, 7 rate hikes, even though rate hikes have nothing to do with any of this crap. But that's what the market priced in. And when everybody sold right here, why did they sell? Because now they told them the news. They're like, you're fricked. You're done. You're destroyed. All your stocks are going to crash because of this rate hike. But little do people know that that was already priced in. That's why the damn market dropped. The market didn't drop because they were scared of anything. They just priced that in as if it already happened. The markets are the most forward-looking instruments in the market as well. They do this very, very well, in which they price things ahead of time to not cause liquidity imbalances.
Zach, can I ask a question?
Yeah.
Sorry. Can you define the difference between uncertainty and fear?
Well, uncertainty is when you don't have information. Uncertainty is basically when you are given something, you're told something might happen, but you don't know how it's going to turn out, and you don't know how it's going to play out. And as long as there's a risk involved with it, the markets will price in the worst conditions. Fear is when you have information about something and you're scared that it might happen or that it's happening and you're scared of it.
Right.
So example of this is let's say right here, the rate hikes. That was an uncertainty issue because we didn't know how many rate hikes we're going to get.
Yeah.
The fear part right here is we have the information. We already know how many rate hikes, but we don't know the effects that it will have on stocks. Why? Because we refuse to believe that this was the correction. But in reality, if you know anything about rate hikes and you know anything about fear, not rate hikes, I mean rate hikes and maybe even things related to the market, you would know that rate hikes are not bad. Interest rates are not negative for the market, at least not for all of it. The markets historically have still done pretty well, on even 2, 3, 4% interest rate markets. It's only once you start topping out on the 5 to 6, 7%, do people really start getting very concerned. But people think that if rate hikes happen, that everything's going to die, which clearly is wrong. But that's the difference between them, is that one of them is based off, no information, but only you have an idea, and then the markets will go ahead and price in the worst conditions, in which in some cases tends to be overblown. right? An example of this would maybe be something like Facebook's earnings, where it was overblown to some extent. Like, why is an $800 billion company down 20% in one night? Why is a company like Netflix down 30% in one? Those are overblown situations in which that stock priced in way too much damage before the earnings was even released. And the same thing with Facebook. They dropped because of the data. They didn't even get to hear Mr. Zucchiniberg or anybody. Those are overblown situations in which there tends to be a recovery. Now, I'm not telling you guys to buy the dip on anything. What I'm telling you is that uncertainty and fear are a huge difference. That uncertainty where the market just crashes or the stock just completely tanks tends to be the maximum pain side, in which usually the markets have dropped 70 to 80% of the worst case scenario. And then if the news comes out and it's even worse than what the market wanted, then you'll get that final 30%. But if the news comes out better, then usually you'll recover half of that destruction, which is basically 35% of whatever you crashed. But that's basically something that everybody should be aware of, is that do not be scared after data has been released. Be scared ahead of the data has been released. If you guys apply this, you guys will know when the market is going to crash, and you'll know when the market bottoms out. Markets bottom out when everything is at maximum fear, not maximum uncertainty. Maximum uncertainty is usually at the top, where everybody's like, holy shit, what's going to happen? Are they going to do it 5 times? Or are they going to do it? Everybody starts to panic and run for the gates. Once you start to near a bottom, everybody starts to get really, really worried. The data comes out and it's really, really bad. Majority of the time, it tends to be really bad. But then the markets reverse. Why? Because the data was as expected. It was bad. If the data came out good, then you reverse even quicker. If the data came out worse than expected, then you'll have to go and see how much did the market price in. And that's basically that. So those are kind of like one of the ways to go ahead and kind of analyze the market based off traps. And I know these are kind of bigger image things. They're not really about trading the 1 minute time frame, but we'll get to that right after. The other thing you have to go ahead and pay attention to is, if you're looking into fear and these other things, is you have to look at fear and greed indexes. You have to look at the put to call ratio. You have to look at the volatility in the market to get an idea of when does fear spike. Majority of the time, uncertainty is not red. You cannot read uncertainty. You cannot read how uncertain people are. However, you could read how fearful people are. Why? Because there's things that track fear, but there's nothing that tracks uncertainty. Fear is usually derived from 2 things. One, by people buying insurance, which majority of the time means somebody buying puts. Or 2, by people being bipolar, meaning that they're very bipolar in their decisions. Those are the 2 things that define fear. It's bipolar movements in which volatility spikes, which is the VIX, or in people buying insurance in which the put to call ratio spikes. And those are the 2 things that define fear. Uncertainty cannot be defined by anything because you don't know what uncertainty is. Uncertainty just means that people just don't know. What they don't know, we don't know. How are we going to track something we don't know? Well, I don't know. Oh, that was nice. Okay. But that's basically that. So if you're looking into things to track volatility and looking for things to track fear, volatility in PC is going to be your best thing. Is when people tend to go for maximum, protection and insurance, and volatility starts to spike, people are very bipolar in their decisions. That tends to be the phase in which uncertainty has peaked and fear is just starting to go around people. And then usually people will refuse to believe in something, meaning that when the markets have crashed and the markets start to reverse, everybody will refuse to listen. Everybody will be like, no, we're crashing, we're going to hell. Ain't no way I just bought puts here and you're telling me we're going back up. Why? Because it's that arrogance that they think is like, no, the markets are in dangerous situations. It's like, yes, they are, but it's already priced in. How are you going to say, no, the markets are still going to be worse? And that's the thing I was saying to people, is that while, yes, we are in a wave 4 correction, it looks really bad, there was a chance we go back to 450. Well, we ended up going above that. But the reason is because insurance was not as healthy as before. People were scared, but nobody was really scared. Therefore, this is a time of volatility. So therefore, there's bipolar investors who just can't make up their mind. One day they want tech, one day they want value, and we're going to see who wins it at the end of the day. But all it takes is one thing to cause them to slip again, and then everybody becomes bearish after everything has crashed. But that's one thing that everybody should have in mind. All right, everybody should have that in mind and should understand it. Now, the next thing, which is basically going to be about learning cycles in the market, everybody should have a basic idea of basic performance in every index, specifically the S&P 500. It shocks me to this day that retail is still so ignorant towards certain data pieces in which they refuse to believe that there are actual cycles in the market where not every good investment, because it's a good company, is actually a good investment, and which no matter how good your company is, it could disappoint, and that there's laws and rules in market or in the finance markets that must be applied and are followed because the people who run this market are the people who taught those subject matters. So you cannot always just make assumptions that everything is going to work out because it logically makes sense to you. Every investment is not always is not always about the fundamentals behind something. Here we talk about so many times that mechanics of the market are always much more important than any fundamentals out there because the markets work on mechanics, they function off mechanics, and fundamentals only try to provide support for those mechanics. If the markets function on fundamentals, everybody would just completely annihilate every stock out there and just buy the top 15, 20 companies because there's only so many good companies in the market, but there's also so many bad companies that can become good companies if properly invested in and given funding to allow them to prosper. If we don't do that, then everything gets destroyed and innovation is discouraged and people will never get the money to start companies and want to be entrepreneurs or start, companies that could really change lives and, allow the economy to grow. So the reason the markets function like that is for that opportunity to allow people to get such things, to get funding for whatever it is that they want, even though the possibilities of success are very low, the markets still provide that opportunity for people. And some people, if you've noticed the past few years, and even just the past 2 years, a lot of companies have been given that opportunity. Few of them took advantage of it. Others basically called in, the door and said, "I'm getting the hell out." So companies like Zoom, companies like Peloton, companies like the EV manufacturers and EV cars and all those, a lot of them have gotten funding. The market has provided them that opportunity, but how many of them actually went out of their way to advance? Very, very few. But the markets expect that, and they know who's going to do it and who's not. And those who decide to abuse the market funding will be abused in return. And that's something you have to go ahead and kind of notice right away is this company that you're talking about, is it really the future, bro? Everybody's always talking about this is the future. Like, is it really the future, though? Because if it is not, they're going to have a time frame. They have a deadline. If it is not the future, bro, you are the past. Okay, you are going to get completely annihilated and erased from the markets. You don't believe me? Go check out which companies were outperforming the market in 2018. Tell me where they are now. You will only notice that there are maybe 6 to 10 out of the 1 to 4, 5,000 companies that were there doing well. And go check in 2008 and go check in 01. Literally only 1% of all the .com stocks, there was very few of them that are actually here till this day. So a lot of companies get very annihilated. And you have to understand what that means. Do not fall into the traps of it's a good company. Okay, I just need to have conviction. It is not about your conviction. It's who's willing to be convicted with you. Who's willing to come in and buy it up with you. A lot of people have hated me so much for telling them like stay away from these IPOs, stay away from the Chinese companies. And I even told them stay away from some of even the companies that did well right now. Right. And that's mainly because those companies have a proof to provide. They need to prove something. And unless they show that proof, they will be completely destructed. They literally will get annihilated. There's no point of return. And those are traps because everybody will come and tell you, go buy them. They're good companies. Go make an investment. They'll do good in 10 years. Based off what data? Well, based off the past 10-year data, in which only one recession has happened, in which only 30% was done, in which only to the S&P, in which 80 to 70% of the market is not even in the S&P. So what correlation are people trying to bring to you? I don't know, but a lot of people tend to fall for that. There's only 500 companies in the S&P, in which almost 60% is underperforming till this day, while the market is up 100%. Learn to read the data properly. Do not get fooled into this idea of just dump your money into an index fund and you'll do good. Do that and watch what happens when a recession hits. Yeah, 10 years later, and you're lucky if you can basically, have your money safely not get outpaced by inflation. It's not as easy as everybody makes it look. Sadly, have to put in some effort. A Roth will not do you that work anymore. It's not as easy to invest nowadays because of how heavily involved retail is in the markets. But the final thing that we have to talk about is actually the deeper time frames in which people fail to understand is markets have a specific cycle, like I said, and every one of you should have a basic idea of where does the market do well, where does the market do nothing, and where does the market tend to do really bad. So here's a few things I want everybody to understand, and I've been screaming it the past 2 months, but very few people listen. I know a lot of my friends and even some of the members in the Discord who got completely crushed by this. And here's the two things that everybody needs to understand. Summer season, right here, from May all the way to September, or you could say basically just the summer season alone, which is May to July, right? May to July. This season, historically, from May to somewhere in mid-July, has been known to stay flat. Okay, has been known to stay flat, which means should you be in the market? Sure, you can, but you need to be very cautious buying call options, thinking you're going to the moon with a $500, $700, $8 target on your penny stock. Majority of markets will stay flat around this time, from May all the way to July. Keep that in mind. And then August historically has been known to be a very weak month. Not a crashy month, but a very weak month. So you expect maybe downtrending pressure. September, right? September has been known to be a shit month for history. And that's mainly because of the mechanics of the market, right? There's many things that happen in September that cause the market to go down. It's not because of the news that comes out. It's just been known for that. So you always expect that in September, there's usually a high chance of a massive downtrend where things get really, really ugly. And then usually the start of October is no better. Tends to basically start to bottom out, and then it eventually starts to reverse all the way until mid-November, and then things chill out. You tend to get your little spike for Santa in December, and then everything comes back, and then you top out somewhere around January, and then you get the season of the year, which is January and February, where the markets historically have underperformed all the way till mid-March. And then April tends to be a very good rush back up from mid-March. These are the cycles you have to understand. Everybody has to know this. So if you are long the market and you have calls or whatever, when should you be very cautious? Well, you should be very cautious from mid-August to end of September. And you should be very cautious from January, usually the middle of January, somewhere around January 10th, all the way to mid-March. You have to be cautious. Do not be an idiot. When are there times of optimism in the market? April has historically been a very great month for investing. Right here. Where's April? Come on. April right here. This one has been known to be a really, really good month for the markets. And then also October into November has really been known to be very healthy for the markets as well. And then, well, again, like I said, the summertime, there tends to be a slow uptrend, but it tends to be flat. So it's very hard to trade. So that's all you really need to understand about the markets. If you cannot memorize those basics and you cannot understand them to protect yourself from the stupidity of how people are easily able to manipulate you, then I feel very bad for you, because you're always going to be caught in these traps and you're always going to be the guy who's buying the dip at the wrong time. I've been telling so many people, don't buy the dip. People just don't get it. They just don't understand it. The other thing you have to also understand is no matter how great of a company there is, one of the biggest traps that people fall into is that they buy the dip on stocks because they're undervalued. Nobody cares how undervalued your stock is. Don't listen to bullshit analysts telling you, oh, your stock fair value at $80. It's trading at 60. Go buy it. No, do not be an idiot. He has no interest in helping you. And why should he have any interest? Neither does Kramer. Nobody has any interest in helping you. Stocks go down for a reason, and they tend to stay down for even a worse reason. You have to go ahead and think with your brain. Every time, before you buy any dip, you have to ask yourself, will the markets correct first? And when we're thinking about markets, what are we talking about? We're talking about the S&P, we're talking about the Dow Jones, and the NASDAQ 100. So they're basically under the tickers SPY, triple Qs, and then also the DIA. If the indices have not corrected, you have to keep this in mind. If the indices are just grinding up and up and up and up and up and up and up, and your stock is down 50%, do not freaking buy. The indices have to correct first. Because if these guys crash, your thing is going down another 50%. Go and look at what happened recently, in which everybody thought they're getting a good value for their damn company here. They're like, look, a firm is down 50% from whatever high it is. Like, it's a good company. And then you just get completely clobbered with another 50% because that's when the market's corrected again. Do not buy stocks because they are down. Buy them only, if you really trust in them, only after the indices have corrected. And sometimes it's very tricky because not all the time do companies correct together with the indices. Majority of the time, if you want to know where a market peaks, start with the companies that are overhyped. They tend to top out first before anything. So whatever is being hyped right now, or whatever is hyped the next season, once you start to see them crash, the market will soon follow. Sometimes it lags behind them because there tends to be a rotation out of those smaller companies into the mega caps, which hold the market, and then the mega caps eventually roll off as well. But for the love of God, write this down and tape it into your head or somewhere. Do not ever buy any stock down 10, 30, 40% unless the indices have went down with it. If they have not, wait until the indices crash, then go shopping if you're a buy the dip guy. Right? And then try to call the bottom and maybe God will help you. Who knows? But that's the only reason you should be buying dips. Do not buy dips on things unless the indices have corrected. I've said this so many times to people, but very few people listen to it. And, you know, they're like, it's a great company and that's all people care about. But very few people understand that there's more to the markets than just a great company. They have to have somewhat of a good reason behind them, or other than that, you know, you're going to be in very deep trouble. All right. So make sure you're cautious with that whenever you are buying dips. The other thing that a lot of people tend to also get basically faked out into is just basics of breakouts and trend lines and all that. Technicals will only get you very far. Understand that. You see, what I saw some people recently doing is we'll do it on the SPX. And the thing with technical traders is they're full of shit sometimes. They don't tend to be very honest with themselves. So I had some guy telling me that there was a channel here. They're like, look, we're downtrending from where? I think he said here and then to here. That was the first thing he drew. And then whenever we broke out, he drew it like this. It was very confusing to see what this dude was doing. And then now, just yesterday, he was showing me that it's like this. And then a few days ago, he was showing me it's this way. It's downtrending. And then another day ago, he was telling me we're going to crash from here. It's a bear flag. There's so many changes to technicals. And if you apply technicals to your trading and you stick to them alone, you are basically the most vulnerable to manipulation. Every hedge fund knows what you're looking at and they see what you're seeing. So don't think that they don't see what you're seeing. Now, do they trade it the same way? No. Why? Because, well, go ahead and look at the data. They tell you that the data for Head and Shoulders is what? 80% success rate? Based off what? Based off it being a Head and Shoulders. That's not true. Because every Head and Shoulders, it is only calculated if it actually breaks and works. They do not calculate the ones that do not break. Meaning that you could have a Head and Shoulders that break down and go back up. But unless it reaches a certain distance, they don't calculate that data into it. Meaning that in reality, your Head and Shoulder pattern that you were told has an 80% accuracy rate only has a 10 to 20% success rate. Why? Because the first thing you do when you go to a hedge fund or you go to work at some Wall Street firm, the first thing they teach you is here's an ascending triangle. Here's what you do. You go and you short it right there. Why? Because retail idiots want to go ahead and buy the breakout, and that's how you get your liquidity to short. Does it mean that every time it works? No. Sometimes they let you pass, sometimes they don't. But you have to know the data and you have to understand it. Do not just believe random data and believe in it and trust it and think that everything will be cool after it. Drawing trend lines works for some places, then it doesn't work for some places. And TA, in hindsight, looks really, really good after everything works. But we don't want to rely on such things. You want to rely on things that have true meaning and true mechanical value, in which you have to look at true fear, you have to look at volatility, you have to look at how many people are buying puts, how many people are buying calls, who's actually scared and who's not. Once you add those information, you'll be able to easily identify in which what situation are you in, and should you sit this one out or should you actually take action and do something about it. In which, if you guys looked at the markets here, some people, we were saying that the only reason this market could go lower is if people stop buying puts and get bullish. And one of the ways to actually fake people into that is to give them a breakout. Why? Because everybody sees this channel, and as soon as you break that channel, that breakout would have been it. Now, expectation was that this goes back to 4,500 and we're good. The puts were all basically, the calls were all at 460, at least the ones that expire this week. But the expectation was 450. Were we right? Well, we got to 450 and went above it. So what? But the thing that we're paying attention to is we're not trying to buy a price. We're not trying to buy the dip. We're not trying to buy anything. We want to get in at a good time. Focus more on getting entries on good times. Majority of traps happen because people want good prices. That's why y'all get baited at supermarkets. That's why you guys get finessed by salesmen. Why? Because you guys are more focused on the prices of things instead of the time that you're buying the thing. You have to focus on the time you're getting yourself involved. If you can get a better time in the market, it is much better than trying to actually get a good price. But hey, who am I? Other people would tell you timing the market is bad, bro. You know, timing the market is better than timing. Well, yeah, we'll see about that. Well, all it takes is just one bear crap, and then everybody is all of a sudden looking real stupid at that moment. You don't have to go ahead and time anything. You're not timing anything by trying to time your trade. Timing a trade is basically you trying to buy the bottom. What I'm telling you is make sure you get in the markets at a good time. Don't buy the bottom. Don't buy the top. We don't care what price you get in. I want you to get in at a very good time in which the markets are looking very healthy so that you can go ahead and make a decent bet on your trades and feel comfortable being in there. You can't just buy them FOMO into shit at the top and buying the dip and everything. That's why you get slaughtered. The reason you're getting slaughtered is because of that. Why? Because everything that goes up, you want to be in it. And everything that's going down, you want to be in it. And it's all about, can I get the best price? Can I get a best price? It's like, it's not about prices. If you look at the markets here, one thing we wanted to pay attention to is we wanted the PC to drop. And in the past days, since the January 24th, you look at the PC, this is the drawing that we did before. What do you notice? Well, the PC came back and it bounced. And as long as it stayed up there in this green area, we said, do not buy the dip on the market. It's eventually going to come down. And if it doesn't, it's going to consolidate and then we'll get to buy. Other than that, trade it, don't invest at the moment. This is the time of volatility. Everybody knows that. Meaning that unless the markets have basically pushed and stay here for a very long time, then the markets will go ahead and continue to go up. Unless they come back to here, in which a lot of people are getting calls, then you'll know the market will fall. So don't short either. So looking at the current market now, do you want to short? Well, shorting here is okay a bit, right? Shorting somewhere around here would have been okay. But unless it's all the way down here, the markets will continue to hold ground. And a lot of people got slaughtered trying to short because they're like, oh my God, we're up 7% for the day. We have to come down. No, you don't. If there's puts there, you're not going nowhere. You're going nowhere but up. Don't try to call the top because things are extended. You guys are not ordered to call tops, which is the biggest trap in the markets is everybody wants to call something. Why? Because I don't know if you guys got an Instagram or something, but people like this idea of saying, I called the top, I called the bottom. Idiot, did you make money? That's what you need to be focused on. Instead of focusing on the bullshit of telling people that you call tops and bottom, how about you zip your mouth and go make money? Don't get too caught up with what people are doing or who called the top or who gave a good alert. Through the alerts, through the info, through everything, focus on you and you actually making money. That's where it really, really matters. Nobody actually gives a shit on who called the top or who called the bottom. Everybody wants to know, did you make money? That's what truly matters. That's what truly has value. And that's what we want to see in markets is we want to be able to understand when are we falling into a trap and when are we not falling into a trap. Well, historically, if you have basically came into here and there's a lot of optimism and euphoria in the market, that tends to signal a very toppy market in which you need to time yourself to get the frick out. Do you have to be out right away? No, but you should be very positioned to somehow get yourself released. And that's basically what we did here is we watched this right here. We saw the development, we seen it happen. And then by here, if you wanted to do anything, this is your time to short because now the markets are getting defensive. And then once the markets start to reach here, this is not the time to get scared and say, oh my God, and the world is ending. Everybody's got in their puts. That's it. Stop trying to short the damn thing. Now you need to start seeing if you can position yourself for the upside. Not the downside, the upside. But instead, well, this is where uncertainty starts to spike. And then by here, around the top, that's usually when the fear happens. That's when everybody starts freaking out. Oh, rate hikes. People are freaking out about rate hikes as if like this new magical, tool that the Feds had in their pocket. There's nothing wrong with rate hikes. Nothing. But to avoid the traps of this situation, you have to know how to position yourself. The better you get at positioning yourself, the more money you'll make and the better your timing will be. And again, the main objective is not to time tops or bottoms. The main objective is to position yourself at a good position by that time. We don't care. You don't have to call the top. You can short as it's coming down. Right? You do not have to short the top. You do not have to buy the bottom. You can buy as it's recovering, but you should know where it's going and how it's going to do and how well it's going to perform. And if you don't feel like anything is clear and things are not too obvious for you, then all cool, just sit and watch. You don't have to do anything if you're very uncomfortable. But this is the thing that has happened in the markets throughout history, and very few people understand that. Why? Because the traps, again, human psychology tends to repeat itself way too many times, and people just don't get it. And usually the best way to avoid it is just by leaving the market, which is what a big chunk of people do is they lose a little bit of money and they're like, whatever, I'm done. Investing is a scam, and we'll call it a day from there. But you have to be very strategic in your investing to avoid traps. The more traps you can avoid, the better you'll position yourself for opportunities. The more opportunities you can better position yourself for, the more money you'll make. And the more money you'll make, the bigger your account will grow, and the more money you'll be able to make over time. And you could do this over and over and over versus being the guy that only gets lucky and somehow magically becomes, the genius of the world because he bought the dip during COVID and now he's giving financial advice to people, telling them, oh my God, you just have to buy the dip, bro, okay? Whenever things are down 5% in one day, just go and buy it. And that's how majority of people get clapped. But these are some of the main macro image type of traps that people fall into. Everybody should be aware of them. All of you should know some sort of seasonals in the market. Again, July, May, June tend to be very freaky times in the market, tends to be very flat. Everybody should know about the volatility of February and March and the ending of January. Everybody should know about the crashes of September. Everybody should know about certain holidays and the value of those holidays. A lot of you should be able to do that research on your own. This is all available data that many of you claim is free on YouTube and that it's free on Google. Search the damn thing up then. Go and find that info. Everything is free, but you guys don't seem to have enough free time to search them up. Go and look at that data and make sure you're aware of this information instead of watching, a 50-minute YouTube video on top 3 picks for next week. It's not always about the top 3 picks. It's about how do you better position yourself for these things. All it takes is one small good month for you to really put in a good amount of money and trust in yourself to make a lot of money. I know people just in the past 2, 3 weeks who have basically doubled, if not tripled, their entire net worth because of this small crash that happened here. And I know idiots who couldn't even double their account as the entire index doubled. It's all about decisions and actually being intelligent and putting in the work to understand something. It's not all, there's not going to be an AMC every year. There might be an AMC every year. There might be a stock in which you just hope you put $10 in and it went to 1 million. That's what you want, then hey, do you. But you have to know that these traps are there. They're there to trap you for a reason. They're there to bait you into making decisions. Retail, YouTube, Twitter, everybody's in the same game. Nobody's playing it any different than anybody. All in the same game. Everyone is trying to outsmart the other person, and only a few people will win. This works in crypto. This works in Forex. This works in the stock market. You have to read what's happening, and you have to look at it in a certain way. And then the other thing, for those of you that like to trade smaller time frames, one of the biggest things that people get faked out into is parabolic movements, in which something goes up, they're like, well, I missed out. And then the thing goes up even more. Or something breaks down and it goes lower, and everybody's like, well, I missed out. I need to not short anymore. Do not get caught up with those things. The only reason you're going to catch these is if you were prepared ahead of time. If you were prepared ahead of time, then you would know what happened. If you were not prepared ahead of time, you will not know what happened. So instead of focusing into the traps of getting into euphoria and fear and all this crazy stuff, focus on developing a strategy, and then maybe you'll get caught up in those things and you will be rewarded. Don't try to time these big pumps. If you had a strategy that was bullish this entire month, you would have been in this move. If you had a strategy you were bearish the entire time, you would have been in this move. There's no way you guys have enough tools and data and information to catch these before they happen, because these are all algorithm-driven moves. They are not driven by individual traders. There are algorithms that are making these moves and reacting very quickly. Well, there's no way to catch it. But the best investing is that you go ahead and just prepare yourself and better position yourself for these things. Other than that, you're going to be in the trap that everybody's in which they buy a breakout that ends up failing. And then what are you going to do to justify that why the breakout failed? Well, there was not enough volume. Volume can only do you so much. The volume can only do so much. There was not enough momentum. The momentum can only do you so much. You have to know, what are people seeing and what are you seeing? If you see a great Head and Shoulders, stay the hell away from it. Probably not going to work out. Or if it does, it'll fake out. One of the best things to actually learn, if you want to avoid many of the market traps, is to learn 1 to 3 market maker cycles. One of the main ones that we talked about here is basically this one that everybody should know. You get a fake out, you get a drop, you get maximum pain, recovery, flag, recovery, and then another push. This is one of the market maker cycles. There are 3 others that are out there that everybody should learn. And you can see them in every type of market. Zoom out and you can see them and you can take advantage of them. You should also be able to see and understand things as you trade. Do not just trade to make money. Trade to actually understand why the hell you made the money. I would much rather that you make $30 and understand why you made it than to make $1,000 off something you have no idea if you can replicate ever again in your life. Because the more you understand how to replicate information, the more likely the information will become more valuable, and the more likely you'll be able to put it again and make 10, 15, 20 times what you're used to. That's a very important thing too. So learning some of the basics about the analysis, instead of drawing your damn trend lines and the momentum and the RSI and all this stuff, try to look at something and see if you can understand what's going on. Why are people buying? Are people buying near a bad time? One of the things that all of you should basically, have a little bit of understanding on what's happening in the market, right? Maybe one of those things could be, pull up the NASDAQ, let's say, calendar for this year. Have all your quad witching events in order. Have your Friday expirations in order. Do some research to understand what the hell happens before quad witching. What the hell happens before the 3rd Friday expiration? I think yesterday they just added this bot back in the server. Look into this thing. It literally does not kill you that on a Friday morning, to avoid many of the traps and not miss out on a lot of moves, just go in the bot and literally just search up this TR top flow. Look where everybody's buying calls and puts. There you go. He already puts it on the Friday or whatever. See, whatever everybody's bullish on, maybe consider to go long on. But if it's coming near a major expiration, look at the heat map. Look where everybody's puts are. Look where everybody's calls are. And then go ahead and see if you can bet against it or if you can bet with it. Do your research. Literally, research is very simple. Do not watch a million YouTube videos learning about an indicator. These are mechanics that will help you avoid those traps. Because if you're on your YouTube, you're literally no better than 90% of traders. Everybody's on YouTube. You have to gain an advantage by learning something that a lot of people do not know how to understand, which is things like this, which is learning where people are buying majority of their puts, learning where majority of people are buying their calls, understanding what euphoria looks like, and understanding what a healthy trend looks like, understanding when things are getting extended versus when things are not getting extended. This is not information that can be taught to you. It has to be self-taught. I can't sit here and teach you this stuff. I could try, it's not going to work. But learning where there's a healthy trend is, basically could involve many things. Maybe you came into a really bad expiration of just extreme bearishness. Well, that explains why there's a massive rally. Or we could even say here, we came off the January 22nd expiration. This is a leap expiration date. We know the consequences of leap expiration dates. These tend to be very hellish type of movements. Tends to be a lot of volatility in them. There's tend to be a lot of options open on them. And since the market has been bullish the entire time, what else do you think is going to happen in the market aside from the market crashing? You think it's going to go up with everybody having calls? Probably not. And then here you can do the same thing. What do you think happened in COVID? Well, with the leap expirations, there was no major leap expirations unless it was the January, it was the January 21st, but then also the mid leaps, which were the June and July. And what do you think everybody had when the market was crashing? They bought these puts. That's why the market just completely rallied into that and then it finally crashed after that. That type of information will help you. Do your research on that. Don't ask how or why. Just give it a shot. Literally, it's simple critical thinking. Give it a shot. If you're confused, then ask. But don't ask ahead of time before doing something. Just literally go and try to see what you could put together and get an understanding of it. This is how you avoid majority of traps, is by learning information that majority of people do not know and learning and understanding information that majority of people may not even have access to or knowledge of. Those type of things will keep you safe, at least from the majority of the harm. They won't save you from everything, but they'll keep you away from the harm and you'll be able to kind of, avoid them. And you could also use them to your advantage in many times. If you see a market coming down in a very ugly way and you're also coming into a weekly expiration, it only makes sense that the markets would pop, that the markets would reverse. Right now, February 18th is right here. If the market rallies into February 18th or February, basically next week, and we go all the way to 470, I would bet you on everybody's life that we're going to crash all the way back 2 to 3 days ahead of February 18th. If the market just goes ballistics right here. Use those things to your advantage. It is not that hard. It is really not that hard. Look at what happened here. What was happening to the market? The market basically started December all the way on the bottom. And we rallied all the way to here. And then the markets crashed for December 17th expiration. And then the markets went up and up, and then the leap expiration came. And then now we're going up and up and up and up. If we somehow get really, really extended, February 14th, basically the week after that, the 17th, the 16th, and the 15th, we're going to come down. And you have to trust in that and do your research. Like, go on here and try to look at the information and see what you can find. But that's also another way to avoid traps from them. If you're trying to avoid traps in very small time frames, if you're an extreme day trader, those type of things can also be avoided too. Learn where your zones are and try to understand market conditions. If you understand market conditions and you can trade stocks that follow the market, that's also one of the best ways to avoid majority of traps. If you don't want to get caught up into them. If you're okay with getting caught up into them, then hey, it is what it is. But if the market is looking very unhealthy and you're in the wrong sector at the wrong time in the wrong market condition, then, well, you basically put yourself at harm. Don't just buy things because of technicals or because they look good or whatever. You have to try to make sure that there are some sort of mechanics in your favor. The more mechanical trading styles you have, or can have access to, the better your trading will become. And there's a lot of mechanics that you can learn. There's a lot of them. You can go ahead and decide which one you want to use. There's mechanics that are heavily involved with seasonals. There's mechanics that are heavily involved with volatility, mechanics that are heavily involved with basically options. There's mechanics that are heavily involved with big money, meaning following the option flow. There's mechanics that involve specific indicators that you can use, like the fear and greed, like the common average, fear indexes. You can also look at hedge funds terms and basically when they short and when they go long and when they use leverage and when they don't use leverage. You can also look at mechanics like speculators versus the common traders, in which people basically calculate how many people are speculating in the market versus how many people are making long-term investments. You can track the bond market. You can track, the currency markets. You can track commodities. There's a million ways. There's no excuse for why nobody's busy 24/7 doing work, doing research, trying to understand, trying to learn. You will only learn so much from people. You have to learn on your own to understand how you can better avoid these traps and how not to fall into them. But like I said, if everybody's doing the same thing and everybody's on YouTube and everybody thinks that they're just going to learn by coming on the call and every one of you is a retail trader, there's like literally one guy in here that probably knows something everybody else doesn't even understand. So how are you supposed to be different and trade differently if you're with people that basically fall into this trap? It doesn't really add up. It doesn't really make that much sense. So to avoid these kind of traps, you have to gain unique advantages. Without unique advantages, you'll repeat the same issues and you'll fall into the same issues. If you're doing heavy intraday deep trading, then technicals might work in your favor for a little bit, but I would suggest you start to look a little bit into the option flow and get a little bit of a strategy going in which you look at the options and you kind of can get, a bit of ranges. I've said this multiple times where all you guys literally have to do, and you can use the bot for this, but if you don't have the bot, let's say you don't want to use it and you're maybe, a rebel of some sort, you can literally just go on bar charts, call the SPY, literally pull it up, click on options here. You can download the app too, and then just choose the expiration date you're looking. We're looking at today. We'll say tomorrow. We're looking at 2/4 right here. And we're going to go ahead and just find where the majority of open interest is. And all you have to do is literally draw two lines. Draw a line at 460 and draw a line at 450. And then all you have to say is, okay, more than likely we'll trade within that day. And by Thursday night, if that option comes up and you're basically at 453, then your expectation would be buy calls off 450, buy puts at 460. Do you have to do it? No. Just keep that in mind that there's something going on there, and then see if you can trade within those ranges. But it will give you that availability and that confidence to know that we're within this range, that we're trading within here. That could be something you could use. The other thing is just check what the most bullish things are and maybe try to bet against them if you have a research strategy that proves to be with it. If you want to follow seasonals, well, this guy already does it for you. Go see what the hell is he buying, why is he buying it, and see if that makes sense. If you want to trade with big money, then see what these guys are doing. There's a strategy for everything. And the only way you're going to avoid traps is if you follow strategies that have a unique approach to investing or trading, but more importantly, they involve many market mechanics, not technicals, not fundamentals. Market mechanics. Okay. And the biggest market mechanic in the market currently is the options market, and it is data and seasonals. Those have been proven to be the best market mechanics. Outside of that, there are many research and papers that you guys can get into and do all that fraud shit and get yourself, locked up in. But those really don't help you at all. I mean, do you really need a call before something gets upgraded and downgraded? Probably not. Just look at the idiot who actually got the call and then just call it a day and follow him. But that's much better for you guys to follow and try to approach the market in that way. And, over time, you do learn a bunch of things and you do get the hang of things. But unless you're progressing and you're adding more and more information to your book, or to your, understanding, you're always going to be in the same situation and nothing is going to change. But if you add information over time, it starts to add up. That's why I'm saying that every one of you should be busy working. You have all that you need. And if there's anything you guys need that I can help you with, I'm here. I'm down to do it with you. You have zero excuses to why none of you are productive 24/7 if you really claim that you want to do this, whatever this is. Whatever, yeah. But yeah, that's pretty much it. I don't want to go too deep into the day trading crap because I'm really not the biggest guy to encourage anybody to day trade. But if anybody has any questions, I'll be here for the next 5-10 minutes, and then we'll go ahead and call it a day.